Have you ever considered leaving Canada permanently? Maybe you're retiring abroad, moving for work, ready for a new chapter. Canadian winter's just too tough for you. If so, you need to understand Canada's departure tax. And these rules have seen some updates for 2025. I'm going to try to give you a clear, practical guide here, what departure tax is, what's changed, how you can defer the tax, and what happens if you later return to Canada. And we'll talk about some real life examples to walk through how the rules apply. So what is departure tax? When you leave Canada for good, permanently, or at least long term, the CRA treats most of your assets as if you sold them on the last day of residency. That means you're taxed on any gains, even if you didn't actually sell. This applies mostly to investments, company shares, and other worldwide assets. It does not apply to Canadian real estate because Canada can still tax it when it's sold. It does not apply to registered accounts like RRSPs, TFSAs, RIFs, etc. It does not apply to business property in Canada. So let's say I own a store up in Canada, I move to the US, I keep operating that store in Canada, so it doesn't apply to that, and also doesn't apply to anything that's any personal property worth under $10,000. If your total assets exceeds $25,000, you need to file Form T1244 listing these assets when you depart. In plain terms, the departure tax is Canada's way of collecting its share of the gains you made while living in Canada before you move abroad. So first of all, what's new in 2025? Here's the key updates. First of all, what's not new? The capital gains inclusion rate is still 50%. That had been planned to increase to 2/3, but that's so far delayed until 2026. So if you're thinking of leaving in 2025 might be a tax-saving window. We're still not fully sure how the CRA and how the government is planning to account for those gains and prorating them and so forth. The second update is an actual update. It's an update to alternative minimum tax. I won't get into all the details here, but there is a big change here that where large gains may now trigger extra taxes of about 5 to 7% that cannot be deferred. We're going to talk about deferring departure tax here in a bit. So if you have large investments or business shares, you got to plan for this, that you may be paying some tax anyways. The last thing is an update for us tax preparers. There's e-filing improvements on the table. As of 2025, we can actually file your departure year tax returns electronically, which we couldn't before. So that's great. No more paper-only headaches. You get your tax returns processed more swiftly, more efficiently. Okay, the good news, deferring the tax. You usually don't have to pay your departure tax immediately. You can elect to defer until you either A, sell the asset, or B, return to Canada. This is Form 1244. File it with your final tax return. Whatever tax you end up owing, they won't charge any interest on it. If the tax owing on the departure tax is less than $16,500, it's about $100,000 of gains, you don't need security on it. But if it is more than $16,500, the CRA does require security. So this can take a couple different forms. You can get a letter of credit from a Canadian bank. You can, you can give a bond security of some sort, or you can mortgage a property. And in practice, in reality, with my clients, that's the most common thing. Usually, if you have a house or a cottage or some farmland back up in Canada, you can put a mortgage on that and give that to the CRA. This is a big deal. You don't have to sell assets just to pay tax when you leave. You don't have to pay any tax, and the mortgage just sits there until you either sell the property or pay the taxes eventually. What if you move back to Canada later? If you still own those same assets, you can reverse the departure tax. So you write to the CRA with your first tax return after returning to Canada, and if it's approved, the departure tax is canceled or refunded if you paid it. You can remove the mortgage, you can remove the security, and so forth. This unwinding option makes deferring even more attractive because if there's any chance that you might come back, so you don't have to actually pay the tax and then get it back. Let's talk about a couple of case studies. So let's talk about John and Mary. They've retired and they are ready to move to Portugal. All they own in Canada are a house, an RSP, a TFSA, and about $100,000 in their non-registered, meaning your normal brokerage stocks and bonds account. $100,000 of gains, let's say. They put $1,000 in, now it's worth $101,000. So that's about $15,000 of taxes. They file the deferral election because it's under the $16,500. They don't need to put any security. They leave owing nothing up front. That $15,000 of tax sits in the CRA account with no interest. If they eventually sell the investments, they would then have to pay that $15,000 of taxes. For many average Canadians, departure tax is manageable, especially if most of your wealth is sitting in a house or an RSP. Think about a different case study, though. We have Ellis. She has a consulting company. She owns shares in this consulting company. It's worth $1 million with a cost base of near zero. So that's a chunk. When you leave Canada, she's facing a deemed gain of $1 million, $500,000 taxable capital gains. The tax bill is about $240,000. She doesn't have this cash sitting around, so she defers. Because it's large, she posts a bank letter of credit as security. So you have to get this letter of credit from a bank. Essentially, the bank is agreeing to extend this credit to you if you need to pay this tax. 3 years later, Alice moves back to Canada and continues her company in Canada. She elects to unwind the departure tax. CRA cancels the tax and releases her security. The lesson here is that deferral and unwinding are powerful tools for entrepreneurs who are increasingly mobile. People are moving back and forth around the world. Key takeaways here. The departure tax is the deemed sale of most assets when you leave. There's still an advantage in 2025. The capital gains inclusion is sitting at 50%. We're thinking it's going to rise in 2026 up to 2/3. Deferral election gives you some breathing room. You don't have to pay any interest. You don't have to pay the cash up front. You need to put in the security if you've got large gains. There's an unwind option that cancels the tax if you return with the assets intact. Retirees often owe very little. Business owners are the ones that are going to need to plan carefully. The biggest bills I've seen are consulting type business owners or farmers with a lot of accrued gains. So in closing, leaving Canada is a big life decision. With the right planning, you can avoid a surprise tax bill, and you can keep the option to reverse it if life brings you back. If you find this helpful, I've also got an earlier video on departure tax with more details in it. And keep on subscribing for updates. We'll be talking again in 2026 when we discuss the capital gains rules, if they shifted or not. Thanks a bunch. Have a great day.